Hello, ladies and gentlemen, and welcome back. Well, these are the days that really separate traders and investors from being great to potentially poor. Yes, the rallies are on 6 to 7% across the major indices, 20% plus on some of the major stocks, and what looks like now the top of course, inflation. But does that mean that we're going for a soft landing? That's what the market's starting to price in. Today, we're talking about the two key levels that really move these markets. And of course, we also need to discuss what just happened. Yep, it's going to be a big video and we've got a lot coming your way. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We've got a big show today going through the macro data. And of course, then we get into the key levels, the lead indicators, and more importantly, we need to talk about yield curves heading forward into 2023 because that's where the big changes were on this market. So inflation has moderated 7.7%. It doesn't sound very moderate yet, but it was underneath the expectations and markets liked it a lot. The curve continues to look to the downside. And previously when this has happened, when it started to turn down, it's actually usually continued that particular process. And the market's probably taking that into account. Now, does that mean that it is the lowest point though for the markets? Not necessarily. And we'll take a look at that soon. Let's have a look at where the inflation was and wasn't. Well, the good news is food came down. Month-to-month acceleration down 0.18 and October's month-to-month change was still up 0.6. but possibly moderating. The big one was energy. We saw that increase. And I think energy is less sticky. Remember, the big problem with the inflation numbers has generally been the stickiness and the type of inflation that we've been seeing. Food, rent rises, those types of things. Utilities, it was pretty bad. Well, gasoline really was the big kind of increaser this month. And the other ones that were down were things like utilities. That's actually really good news. And of course, food, fuel, oils, eggs, all of those things moderating slightly. So it was a good result in those aspects. The market liked it a lot. So before we keep going along with today's video, I just want to remind everybody we are running a competition at the moment for, of course, our courses. There's thousands of dollars of value there. All you've got to do is enter, putting your name and email address in. And if you follow us on the socials, that would be great. But I do want to discuss the idea of course, whether we've got a soft landing. That is the perfect scenario. Inflation comes down, it stays underneath interest rates for a period of time, the economy can handle it, and then we see a recovery in stocks that continues to slide through. Well, it's not necessarily just there. Remember, stocks typically do experience a correction during the early stage of rate hike cycles, but specifically, the biggest problem usually happens actually after the cycle stops, after they start to cut, because the economies tend to go into recessions around that period of time. There could still be a problem with these markets. We know that if a recession is likely to happen in the US, it's going to happen during 2023. And I think the stats still sit at 90+% likelihood of that occurring. Of course, they change the yardstick every single couple of weeks on what a recession means nowadays, but it's highly likely. Conditional seasonality actually has an uptick around this period of time. Usually around that 10th to 11th of November, you do start to get that middling run through into the Christmas rally. Will we have a Christmas rally in 2022? Well, time will tell, but we've certainly got some great stats coming through later on. Now, in terms of huge days on the markets, I shared this on Twitter, and it's just a bit of an idea of all of the previous big days. Of course, we've had a 7% plus day here in 2022 for the NASDAQ, and you'll notice that often these were bear market rallies. In fact, statistically, they generally are. You can see how many yeses there are to how many nos there are. So before we say, oh, we're pivoting, we don't necessarily know that yet. From an investment standpoint, it's very important that we can actually look and, of course, see the forest from the trees, as I said here when we were talking about this quick private stream. If you're interested in following our Twitter, you definitely should do it. I'm going to be posting a ton more there over the next coming weeks. This is an exciting time for markets, but at the same time, we've got to be able to really have that clarity of thought through these times. Remember, guys, I want to say something to everybody here. FOMO is real. I know what these days feel like to a lot of you out there. I've seen lots of them over, my 15 years kind of in these markets now. And these are the days that really separate success from failure. If you jumped in, if you straddled the market for the big move with options and you made money that way, well done to you. If you have gotten in and you kind of feel the FOMO and you're up, did you enter with the correct risk reward? These are questions that I always ask myself, and you've got to be honest in trading and investing. It's just how it is. Q3 earnings beat data, 58% beats 1498, misses 1087. Still pretty sick in terms of the earnings. But, you know, that's the way it kind of goes at the moment in these markets. Nothing really has looked that good recently, and there's still some problems with unemployment that we'll discuss later. So just before we jump into the charts and we take a look at the key levels that we should be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. We need to discuss sector rotation because here's 5 days, and what you'll notice is semiconductors and semiconductor equipment have been doing quite well. So has gold actually over this period, which we've been discussing on this channel. When you take a look at the last 24 hours of market action though, it was massive. Again, semiconductors and semiconductor equipment were the two best sectors. These high PE ratios, they were doing the best through the session. It was really a movement into tech, and anything that had been, I guess, bashed from a PE valuation was suddenly going up. That's what the market was thinking. They're thinking soft landing. You do need to have a platform like Tiger Brokers platform to be able to see these sectors a little bit better. And do remember, it's important also to be able to set alerts. We've been talking about Tesla a lot at that 180. For anyone that had a go at that in the session, they would have been pretty happy. Obviously, the market went up pretty well in Tesla, and a lot of stocks were hitting those demand zones. So make sure you have an alert service that's setting in your charts, and also that you have something so you can see the rotations through these market conditions. If you're interested in finding out anything more about Tiger Brokers, then remember they just won the CanStar 2022 results for outstanding value. That's a big deal for them. And we are running a special promotion to celebrate what they've been doing. So for Australian and New Zealand traders out there, if you're interested in opening, you can get an additional 40 zip stock at the moment. But on top of that, we're also giving away 1 month FX Evolution private community access as well. So if you're interested, you can sign up with them, and the 1 month private access will also work on all the other links. So if you're thinking of signing up, why not do so today? All right, let's get into the charts, guys. Let's start talking about what's going on with these markets. The VIX, the volatility index, is almost back down to 20, a huge drop in that over the last couple of sessions. The main reason why was, of course, this huge inflation number. And it really came through with yields. Yields are where the big changes happen. But I'll say this, the market's getting a little bit carried away considering how the yields have dropped. Yes, they've dropped 4.332 on the 2-year, and they're almost back down to the 24th of October. Remember this when we go through markets a little bit later on. What I want to discuss, though, was the forward yields. We'll just have a quick look at 10-year, 3.822%. Now, this was a fairly significant drop. This dropped 6.71%, made a new low, certainly significant on the US 10-year, one of the most important yields. Let's now look at December 2022. Not much change there. That's expected. We're still probably going to see those hikes come through. Then we've got April of 2023. Now, this is where it gets interesting. Still 4.855%. Remember, October, what was it, the 28th? So we basically, and the 24th, we saw highs and lows around these periods of time. So again, it hasn't realistically dropped as much as you would think considering where the market's gone. So we're still looking at 4.855%. The big change was when we go out. Let's push till September 2023, 4.75. Then let's push to December, 4.4. Wow, that's a big change. So the other day, remember, we've been talking about this. We had 5% December. We now have effectively 2 potential rate cuts in the market from the expectations into the back end of 2023. The market is really anticipating that we're potentially killing and we're going to deal with inflation, the soft landing scenario. So the yield curve kind of looks like this. We push, we still remain quite high, but at the back end of 2023, it kind of looks like this now. This is a huge change from where it was just flatlining only a couple of days ago. This is what you have to watch. Right now, what the bonds market is telling us about the future is incredibly important. And of course, what like this? Well, bonds came out to play. High yield bonds had a great session on them. It's only up 3.11%, but bonds certainly liked it. We also saw LQD corporate grade bonds do even better, 3.37%. And TLT as well, having a great session. This is, of course, the 20-year Treasury bond having an amazing session doing 3.85%. So does this mean the worst is beyond us? Well, it's certainly a good sign in the steps of recovery. We want to have the bond market specifically coming with us if we're to believe in the rally. And at this stage, it is. We will continue to watch that. Another thing we want to come with us is copper. Dr. Copper has a strong move on it. However, it has made it back to these issue points, the supply zone for Dr. Copper. You can see it looks like it's basing. A lot can change, but what an important zone. Start watching copper on your charts the next couple of days. This is a big level for it. And if it breaches out, we have to think that their market is moving towards maybe some form of further rally. So this is a key point, and it's going to lock in very well with the dollar index, with, of course, SP500 and everything else that we're looking at. Speaking of dollar index, what's going on there? Big change here for the DXY. This is going to be the most important chart for us to be watching over the next 24 hours, even more so than copper. The reason? We're in that heavy demand buying that we saw previously. Now, the dollar is actually quite weak. It's back down to September and August periods. We've been following this story, and in the previous session, we'll talk about that in just a second, we saw it rally into a drop. Now, I want to talk about that because what happened before the market came out with news was something that really stopped me from saying this was the biggest chart of the day. So remember in the previous session, we wanted the market to take the high. It kept going and going though before the announcement came out. That was unfortunate because it put it into this supply. Then, of course, it dropped off. Now, all of this sell mostly happened in 1 to 2 minutes. Very tough to get it on a day like this day. So it's tough to get into those types of positions. Now, if we have a look at the dollar index here, we'll notice it's come back down into this zone. It's now in its lows. This gives us something to work with, though. We now have a little bit of structure that we could potentially start to see from the DXY. Do we have a turning point? Well, we'll have to set alerts here. At the moment, it looks like the DXY is incredibly sick. If it starts to recover through the session, we end up making it above here. That could be a good signal that we're basing at demand and the DXY may start to move up. That's if, okay? It has to therefore do this. You can't predict it. Remember, you have to have the patience to react to the market telling you it's ready to move to that next zone. There's a lot of movement here, which didn't really necessarily get a huge amount of trade volume through it. Remember how much liquidity was here. It's pre-market. There's going to be orders there, but the market probably didn't get fair exchange of value. So it may want to move up later on. How many times have you seen this type of thing play out? Quite a few, I'm sure. So we're looking for the dollar index to potentially rally to get through these zones and then to show some form of recovery. At this stage, we haven't seen it, but it's important. Now let's have a look at the euro. So the euro has swiped the highs here. This was our other supply area. No turn yet. Absolutely no turn. We haven't seen any signs of the turn occurring at this stage. Now, if we scroll down to smaller time frames, go to the 2 hour, you can see absolutely nothing there. We go down to the 5 minute and we still don't see too much action that's really occurred. Now, there was some weakness that could have come through here. The DXY didn't really agree with this weakness, but we now have, of course, a potential turn that could happen. And if it gets underneath these areas here, we know that that's a good idea for a turn towards the downside to potentially come back to then pick up some ralliers. Markets really work on fear and greed. Right now, you'll be feeling extreme greed on these markets and you'll be saying, I need to be in. Where can I find the opportunity? The key is being able to wait for the best opportunity if you missed this rally. And this rally was definitely tough to get. Most people would have been entering somewhere in here. And while they're up right now, this doesn't necessarily present the best reward for risk style scenarios. Gold had another great session. We've been talking about gold now for about a week. We've really liked gold. It didn't find any weakness in the previous session. Just bam, another one. 1, 2, 3, the third move. I mean, incredible moves here for gold. I, again, wouldn't FOMO into something like this. I'd be waiting patiently. It's a great move, though, because what it's done is it's solidified not only this double bottom over here, which was already solidified, but it's basically said, you know what, we're out of this range. Gold looks really good. In a lowering interest rate environment, or even potentially some form of stagflation in 2023, which is still possible, we like gold. Gold is the type of thing that tends to do well in these periods, and GDX had another banger session. And of course, yeah, it may not be semiconductors, but it was up 7.51%. You can't hate. And this has been quite a few days of a strong GDX. I'm pretty happy with this move. It's been a long time coming on gold to see that kind of accumulation, to see that type of huge volume. Obviously, there was loose lips onto this trade because that volume switch is massive. Don't feel FOMO. Again, if you miss opportunities, you look for the next ones. There's always another opportunity around the corners. Let's have a look at XLY versus XLP before we go into the stocks. This is, of course, consumer discretionary versus staples. It was a good day for discretionary in comparison to staples. We saw a rally there. This is still not really consistent yet with a broad-based rally. We'll have to find out what happens over the next couple of weeks. But yeah, XLY, XLP did bounce up. And of course, depending on how the Friday session goes, we might actually hold here. And we need to be paying attention a lot to this indicator, because if XLY starts to lead, if we see technology starting to lead heavily us out of this base, then we have to be paying attention. Is this actually the bottom of the markets? Still, we suspect probably not, but at the same time, it's something that you must consider. Let's have a look at the old economy versus the new economy. We do that by taking the Dow versus the S&P 500. Well, as expected, lowering inflation. Overall, the new economy liked that more than the Dow did. And that's because oil won't really do that well off lowering inflation. It's not the type of thing that usually tends to do well. The Dow has a bunch of those stocks, a bunch of industrial stocks. There's no doubt that the tech stocks had their day in the sun over the last 24 hours. We move over to something like Tesla. Nice to see the weekly actually finding that kind of wick off here. This was our base case scenario, of course, the 180 zone. It got down to about 177-ish or whatever it was, and it's rallied off that session. Again, it came out hard. Let's have a look at the 5-minute, 10-minute chart. Actually, we'll just use 15. You can see here, pretty nice on the session. In fact, this was a great trade. Anyone that got this one, congrats to you. I know it wasn't the best percentage on the day, but still 7.39%. Very nice, right around the level. And once you saw that rally into the dump, oh, it was pretty good. So congrats to you if you got into this one. Nice rally. Of course, we'll look at the stock market to see what we think next for Tesla. But that's exactly why you wait for those key levels. And you even got the opportunity to see that dump into the rally. So that's exactly the way you wanted to be playing it. For now, looks pretty strong on the daily. Obviously, a rejection wick. And if the markets keep rallying, then you'd have to expect Tesla to do so. If Tesla gets a new low, though, which we'll now set an alert for just in case, watch out down below. There's really not much holding it before it gets back into like those 140 levels. Apple is the big one. That's the story of probably the session. We get the double bottom, which actually already completed theoretically from the range. But we get the double bottom, we get the gap fill for this particular gap that was left. We've obviously left a huge gap now down the bottom, which could be where markets come down for buyers later on. It's possible. And it looks like we're kind of beginning a bit of a rally, but the S&P 500 will probably tell us the story here. Again, a lot of stocks at the demand zone, in particular Apple, that controls the market a lot, was right at that perfect level. Let's have a look at the weekly just to get an idea of how this would look. This, if it closes this way, is 1, 2, 3 wicks off this demand zone. You can just see how powerful it is. And yeah, we didn't know necessarily, but we did certainly know this was demand. It just so happened that inflation was lower, so it pushed through. The DAX is doing really well. It's broken that trend line a few days ago. It's continuing to pump. You would think that the DAX wants to go towards kind of that 14,500 zone. I'm actually going to set a little alert for that. And I think this is probably consistent with the stock market, the US stock market, going for a couple of levels we'll discuss soon. Speaking of the US stock market, this NASDAQ, oh, wow, it pulled and it pulled hard. In fact, it's back at these highs. Now, this is exactly where you expect the stock market to start to struggle a little bit. That's a big rally. Of course, it's going into resistances. There will be some take profits, you would think, around this area from day traders, from people locking in percentage. It's at the top of this hike. Now, you'll notice we have an alert that we set here for a while. We obviously had this one here for the CPI just in case it went bad, because that was going to potentially create a waterfall effect. And we've now find ourselves at the peak, at the tippity top. I want to use the S&P 500, though, to illustrate where we're at. So here was the close of the session. It closed right in that secondary supply, And we know that if we breach this by too much, we're probably moving towards 4,100 to fill this gap here, that further rallying of this market. That would be pretty extreme. If we take a look at the futures market, again, we're right at that tippity top. So let's have a quick look here. Here's the 39.62. The market's testing that at the time of this recording. Right around here is where I would expect potentially some shorters to start to potentially start placing something, or at least have an attack on it. It's right at that zone. Very aggressive markets here. To go at this short, you have to know what you're doing. You have to understand it. And what I'm looking for, small time frame, to even appease this kind of thing as a short, is to see some structural base, just like the DXY, which will probably be the precursor of this. I want to see it do something like this. Even come underneath here now, we already know that's demand, then rally, then drop. That would be the way you'd have to play this market. It's very aggressive. It's very tough to go against these trends. It's squeezing shorters that are everywhere through this market. And that's what the news does. Sometimes it goes in these ballistic ways, and these are the ones that you often remember. But remember, a lot of the time, just like non-farms, the news can go like this. The wrong way, the opposite way, the wrong way, and then it just kind of ends up going in that direction afterwards. So you don't always know it's going to be like this huge, giant rally. We're at the resistance though. This is a key point, no doubt, for the markets, and how it interacts with this area will tell us a lot about the next 24 hours. Unfortunately, we don't have that information yet, but what I will do is set in a little alert just underneath here, just in case that does occur. I'm looking at the dollar index the most though for this. So does this play into our options scenarios? Well, technically, yes. I mean, basically all of the puts are going to most likely expire worthless. We obviously had that 365. We could have shocked down to that and then maybe bought back up by Friday. In this case, all we did was we rallied. Now, a lot of people say, but we should have been seeing max pain. Max pain is a concept, sure, but what we want to be looking at is usually the third week options expiration, which just so happens to be next week. And we need to be thinking about the puts. So here, all of these puts are going to expire worthless. If we look at the 18th, this was always my biggest problem. How could we go lower with so many options set to expire? 4.887 million options sitting, all of them mostly puts. Obviously, max pain at 380, and now some calls coming through. I expect over the next week, we'll see tons of calls opened, and this actually will open up after the third week expiration for the possibility of the squeezes here to be met by sell demand. So just remember, look at these options. We will be doing this on the channel. Make sure to follow it, and we'll be following as much as we can closely on this one. Bitcoin is rallying at this stage. It's back to 18,000, pressed basically by the market more than anything else. And 18,000 is a pretty big deal. Look, has it come through? Not really. I mean, here's an issue for supply. This is where you expect it to potentially weaken. And what I'd be looking for again, if I was trying to trade Bitcoin right now, I'd be probably going, okay, down to here would be fantastic. If we see that, then we try to short it again. At this stage, the recovery is obviously through all asset classes. So Bitcoin is coming back to that key 18,000 kind of 500-ish zone. And that's where we've seen previous selling and previous supply. So yeah, Bitcoin coming back, making a higher high. If it starts to switch, that will be important to note. As always, guys, if you enjoyed today's video, please remember to subscribe, smash that like button, and also check out Tiger Broker's special offers down below. Remember, 1 month free access to our Discord if you're a new member, and you sign up using the description codes down below. And yeah, as I always say, practice patience, guys. React, don't predict. If you miss opportunities like this, it doesn't matter. As a trader, why do you care? All you really matter is all about risk reward. How much risk did you have to take? How much reward were you gaining? If you make 5-1 out of a 0.3% move and you do it replicatably, that is where the real power and the real action happens. For investors, of course, it's a tough day because if you missed out on things, you feel pretty bad. You've just got to be patient and, of course, have a strategy where you always have some optional scenarios. Thanks so much. Catch you next one. Bye for now.